Finance and banking news today, top 10 market developments. Disclaimer: the information provided below is for news and informational purposes only. Nothing in this report constitutes legal, financial, medical, or official advice. All content is presented as news analysis, and any anecdotal stories should not be treated as advice. Always consult professional advisors for any financial decisions. This comprehensive report covers 10 major developments in the finance, banking, and stock market sectors, with in-depth analysis and subpoints for each topic. 1. New Federal Reserve leadership faces a historic balancing act. Paragraph 1. A rare change at the U.S. Federal Reserve's helm took place this week as Kevin Warsh assumed chair, succeeding Jerome Powell. Warsh's tenure begins at a critical juncture, with inflation running at its highest in 3 years and economic growth cooling. The central bank's balance sheet stands at an enormous $6.7 trillion, a legacy of quantitative easing, and Warsh has signaled a desire to shrink these holdings. However, reducing the Fed's balance sheet by selling off bonds could push up long-term interest rates and potentially rattle financial markets and the broader economy. Warsh is known for his hawkish stance on monetary policy, historically favoring higher interest rates to contain inflation rather than easy money policies. He steps into the role as global markets watch closely, aware that any abrupt policy moves by the new Fed chief could have far-reaching consequences for stocks, bonds, and credit markets. Concerns are heightened by President Trump's push for looser policy in the lead-up to the 2026 elections, which could put the White House at odds with Warsh if inflation remains high. Paragraph 2. Warsh's appointment comes amid lingering political pressures and unusual economic headwinds. During Powell's final months, President Donald Trump repeatedly criticized the Fed for not slashing interest rates further to stimulate growth and lending. Warsh, however, built a reputation during his earlier tenure on the Fed's Board of Governors, 2006 to 2011, as a steadfast inflation fighter. His track record suggests he will not shy away from raising rates or holding them high if prices keep rising, even if such moves are unpopular. Yet with U.S. inflation elevated and external shocks like high oil prices feeding into cost pressures, Warsh enters a tricky position. Investors are bracing for possible interest rate hikes if inflation doesn't cool, which would mark a shift from prior market expectations that rates might begin coming down later this year. Warsh's initial remarks before Congress emphasized restoring price stability over appeasing markets, indicating he might prioritize long-term economic health over short-term market gains. Paragraph 3. The Fed's challenge is further magnified by a precarious stock market and the risk of policy missteps. Wall Street is near record highs. All major U.S. indices have soared this year, and valuations are stretched, raising the stakes of any policy changes Warsh pursues. Some analysts warn that moving too aggressively to reduce the Fed's massive bond holdings or to hike rates could send long-term bond yields surging. Higher borrowing costs, including mortgage rates, could cool economic activity, potentially deflating the stock market rally. On the other hand, doing nothing about the Fed's huge asset pile might fuel financial excess by keeping credit conditions too loose, potentially leading to asset bubbles. Warsh has openly stated his view that the Fed should get out of the fiscal business, implying a retreat from its extraordinary support of the bond market. This stance leaves investors cautiously assessing how the Fed under Warsh will navigate a no-win scenario, a $6.7 trillion conundrum, where every path carries significant risks and there's no easy solution to satisfy both growth and inflation goals. Subtopic: hawkish stance of the new Fed chair. Kevin Warsh's policy approach has historically been hawkish, meaning he tends to favor tighter monetary policy to combat inflation. Warsh gained experience during the 2008 financial crisis and often opposed aggressive rate cuts, believing that higher interest rates are necessary to curb inflationary pressures. His track record indicates that Warsh will be less inclined to keep interest rates low for prolonged periods, even if the economy faces turbulence. This contrasts with the more accommodative stance of his predecessor, Jerome Powell, who oversaw emergency rate cuts during the pandemic years. Warsh's hawkish leanings suggest that investors should prepare for a Federal Reserve more willing to raise rates or keep them elevated if inflation stays above target. This approach could strengthen the central bank's credibility on price stability, but it may also lead to friction if political leaders, including President Trump, push for easier financial conditions ahead of the elections. Subtopic: the $6.7 trillion balance sheet dilemma. Warsh inherits a Federal Reserve balance sheet near $6.70 trillion, built up through years of bond buying programs. He has advocated unwinding these holdings, arguing the Fed's outsized balance sheet blurs the line between monetary and fiscal policy. However, offloading trillions in treasuries and mortgage-backed securities won't be simple. Selling those assets en masse could drive bond prices down and yields up, essentially tightening financial conditions even without formal rate hikes. On the flip side, leaving the huge asset stockpile untouched might keep long-term interest rates artificially low, encouraging risk-taking and potentially creating market bubbles. This balance sheet strategy, to shrink or to hold, is at the core of Warsh's conundrum as Fed chair. Financial markets are extremely sensitive to signals about how and when the Fed will address this unprecedented asset portfolio, knowing that either path carries significant implications for credit markets, lending rates, and stock valuations. Subtopic: implications for interest rates. With inflation at multi-year highs and the Fed's new leadership prioritizing price stability, interest rate policy is under scrutiny. Markets that once anticipated rate cuts later in the year have quickly reversed those expectations. The startling rise in producer and consumer prices has increased speculation that the Fed could resume raising rates or at least maintain the current high rates longer than previously thought. Warsh's hawkish bent reinforces this view. He may not hesitate to tighten further to ensure inflation comes down. On Warsh's first day, bond markets responded by pricing in higher chances of another rate hike in the coming months. Such expectations have already led to a rise in bond yields, signaling that financial conditions may tighten under Warsh's stewardship. Conversely, if inflation begins to ease, Warsh would likely prefer to hold rates steady rather than cut them too quickly, reflecting a cautious approach to avoiding a resurgence of price pressures. Subtopic: market reactions to Warsh's appointment. The stock market's initial reaction to Warsh's appointment has been mixed, reflecting both relief at having clarity on Fed leadership and wariness about potential policy shifts. The Dow, S&P 500, and Nasdaq initially ticked higher on the news of Powell's term ending and Warsh's confirmation, perhaps buoyed by optimism that a new chair would handle inflation decisively. However, investors are mindful that Warsh's regime could mean fewer interest rate cuts or even additional hikes if inflation persists. Tech stocks, which have benefited from low interest rates and abundant liquidity, saw some volatility as traders digested the implications of a more hawkish federal financial stocks, including major banks, mostly rose on the news, anticipating potentially wider interest margins if Warsh's Fed leads to elevated rates. Overall, the market remains on edge, tuning in to every statement from Warsh and the Fed for hints of how the policy outlook might evolve under his new leadership. Subtopic: Trump's influence on Fed policy. The backdrop of Warsh's appointment is intense political interest in Fed decisions, notably from President Donald Trump. Trump broke with precedent by openly pressuring the Fed to slash interest rates to spur economic growth, a stance that contributed to Powell's strained relationship with the White House. Now, with Warsh as Fed chair, the dynamic will be closely watched. Trump endorsed Warsh's nomination precisely because of Warsh's preference for moving the Fed out of the business of financing government spending, but also because the White House hopes for a more compliant central bank. Warsh, however, may not align neatly with those political wishes. His hawkish tendencies suggest he won't cut rates merely to satisfy short-term political goals if inflation isn't under control. This could create tensions between the Fed and the administration, adding an extra layer of uncertainty to the financial outlook. Investors are bracing for a potential tug-of-war between economic data, which might call for restraint, and political pressure for growth-focused policies ahead of the upcoming election season. Subtopic: no easy answers for the Fed. Warsh's immediate test revolves around a historically expensive stock market and persistent inflation, both pulling Fed policy in different directions. The S&P 500 entered this year at one of its highest valuations on record, stoking concerns that it might be a bubble inflating on cheap money and optimism. If the Fed tightens policy or reduces the balance sheet, it risks pricking this bubble, potentially triggering a sharp market correction that could reverberate through the economy. Meanwhile, if the Fed stays on hold, markets could continue climbing to even frothier valuations, and inflation could rekindle Warsh's conundrum lacks a straightforward solution. Every path has potential downsides. This precarious situation underscores how central bank decisions now must carefully balance curbing inflation without causing a disruptive market downturn, a balancing act that will define Warsh's early tenure at the Federal. Subtopic: Global impact of U.S. policy shifts. Global markets are watching the Fed's new direction because U.S. monetary policy has a profound impact beyond America's borders. In recent days, emerging markets have already felt pressure from shifting Fed expectations. The prospect of higher U.S. interest rates has begun to spark capital outflows from some developing economies. Higher U.S. rates often strengthen the dollar, making it harder for other countries to manage their own currency stability and debt. Meanwhile, European central bank officials have also voiced concern that the war-driven inflation could force them into their own rate hikes. Warsh's decisions on interest rates and the Fed's balance sheet will ripple across global equity and bond markets. The world's financial community recognizes that the U.S. is at the center of the global rate cycle, and Warsh's tenure will be critical in shaping the international investment climate for months to come. 2. U.S. inflation surges to multi-year high, fueling rate hike expectations. Paragraph 1. Inflation in the United States has accelerated to its fastest pace in over 3 years, raising alarms on Wall Street and Main Street alike. Fresh data from April show the Producer Price Index, PPI, jumped 6% year-on-year, significantly above economists' expectations of around 4.9%. The surge in PPI, a measure of wholesale price inflation, follows a spike in consumer prices, CPI, in March to an annual 3.3%, up from 2.4% the month before. This jump in prices is partly attributed to rising energy and commodity costs, including a sharp climb in oil prices due to geopolitical tensions. Prices for producers and consumers are now climbing at rates not seen since early 2023, rekindling memories of the post-pandemic inflation surge. The simultaneous rise in PPI and CPI suggests that inflationary pressures are broadening through the economy, affecting both businesses and households, and indicates that higher input costs are being passed on to consumers. Paragraph 2. The surprising strength of inflation is complicating the outlook for monetary policy and the economy. Financial markets have quickly recalibrated expectations, with many traders now betting that the Federal Reserve might consider further interest rate hikes or, at minimum, delay any previously anticipated rate cuts. The Fed's benchmark interest rate remains elevated, and policymakers at the central bank have already signaled a cautious stance due to persistent inflation. Bond yields have edged up in response to the inflation news, reflecting investors' expectations of a prolonged higher rate environment. Meanwhile, consumers are feeling the pinch. With prices of goods and services rising, household budgets are tightening. Retail sales growth has begun to slow, especially among discretionary items, indicating that consumers are turning cautious amid higher costs for essentials like fuel and food. If inflation continues to overshoot expectations in the coming months, it could dampen economic growth by eroding consumer purchasing power and forcing still tighter financial conditions. Paragraph 3. Energy and commodity prices remain significant drivers of the current inflation wave. The recent conflict in the Middle East, which has disrupted oil supplies through critical routes like the Strait of Hormuz, sparked a surge in crude oil prices earlier in the spring. While a brief ceasefire had temporarily eased oil prices in April, renewed tensions have kept Brent crude near or above $100 to $120 per barrel, contributing to higher fuel prices globally. These elevated energy costs are feeding into broader price increases as transportation and production become more expensive, leading companies to raise consumer prices. Supply chain uncertainties for key commodities and persistent global demand are further adding to costs. This combination of supply shocks and strong demand-driven inflation underscores the complexity of the current economic environment. It highlights the challenge facing policymakers. Inflation now reflects both robust economy-related demand and external shocks, making it harder to contain without risking the economy's momentum. Asterisk subtopic: Producer prices hit three-year peak. April's Producer Price Index, PPI, increase of 6% marks the fastest annual rise in wholesale prices since early 2023. Economists were taken aback by how much producers' costs jumped, overshooting forecasts by more than a full percentage point. Core PPI, which strips out volatile food and energy prices, also surged to 5.2% year-on-year. This acceleration indicates that inflationary pressures are not confined to just energy or food, but are spreading across a range of products and industries. The higher PPI suggests that many producers are facing sharply rising costs for raw materials, transportation, and labor. These rising costs often lead businesses to raise their selling prices to protect profit margins, which can push consumer inflation higher in turn. The multi-year high in PPI signals strong pipeline inflation that may soon show up in the prices paid by consumers at the retail level if companies cannot absorb the cost increases. Asterisk subtopic: Consumer price inflation back on the upswing. The Consumer Price Index, CPI, a broad gauge of household inflation, has also re-accelerated. March saw the CPI rise above 3% year-over-year asterisk, reversing the sharp deceleration that occurred after the initial post-pandemic inflation surge. Key drivers include asterisk fuel prices asterisk, which jumped due to the oil shock in early spring, and rising costs for food and services. Importantly, underlying inflation remains elevated, even excluding volatile food and energy components. Core inflation is running above the Fed's target. Asterisk many Americans are feeling the strain of higher rent, groceries, and gas, even as wage growth continues in a tight labor market. This uptick in consumer prices has dashed hopes that inflation was on a steady downward path back to target. Instead, the data underscores that inflation remains a stubborn challenge asterisk, influenced by a mix of internal demand factors and global supply shocks. The latest CPI report has sharpened the focus on the Fed's next moves and raised concerns about how persistent price pressures might affect consumer confidence and spending patterns. Subtopic: Market reaction and rate expectations. The inflation surprise has jolted financial markets, prompting investors to reassess interest rate expectations. Just weeks ago, many on Wall Street had anticipated that the Fed might begin cutting interest rates later this year if growth slowed. But with inflation flaring up, those calls have largely asterisk evaporated. Instead, traders have raised odds that the central bank might extend its rate pause or even hike one more time star. This shift is visible in the bond market asterisk U.S. Treasury yields have climbed to multi-month highs as investors demand higher compensation for the risk of persistent inflation. Stock indices, which were buoyant, briefly wavered on the inflation news as higher rates could weigh on future corporate profits. Bank stocks fared better amid expectations that higher inflation would keep interest margins wide, while high-growth tech stocks experienced volatility on concerns over rising discount rates. Overall, the surprising inflation data has left markets pricing in a more aggressive policy stance from the Federal Reserve and a bumpier road ahead for the economy. Asterisk subtopic: What's driving the price surge? Several factors are colliding to drive U.S. inflation higher again. A major influence is energy costs. Crude oil, diesel, and gasoline are significantly pricier than they were a year ago due to geopolitical disruptions. A prolonged conflict involving Iran and strains in global oil supply chains have kept fuel prices elevated. Additionally, strong wage growth in certain industries and lingering supply chain bottlenecks in semiconductors and other key inputs have put upward pressure on prices of goods like cars and electronics. Simultaneously, the robust job market and rising wages in some sectors have kept consumer demand resilient asterisk, allowing businesses to raise prices without losing customers. This combination of supply shocks and solid demand means inflation isn't only a transitory blip, it reflects a broad-based increase in costs across the economy. Policymakers are monitoring these drivers closely, as any additional asterisk shocks or wage price spirals could further entrench inflation. Asterisk subtopic: Impact on consumers and businesses. Rising inflation is hitting both households and firms in tangible ways. Consumers face higher prices at the gas pump and the grocery store, prompting many to cut back on discretionary purchases. Background conversations in the retail sector indicate that families are shifting to cheaper brands and postponing big-ticket buys. For businesses, the cost of materials and transportation has spiked, squeezing profit margins unless they pass those costs to customers. Small businesses, in particular, may struggle if they can't easily raise prices without losing their customer base. For manufacturers, higher input costs and wages mean lower earnings unless productivity improves. Altogether, high inflation acts like a tax on the economy, eroding real incomes and complicating business planning. If these trends persist, they could slow hiring and investment, making inflation not just a consumer problem, but a broader economic headwind that could hamper growth if left unchecked. Subtopic: Historical context and comparisons. The current inflation scenario is notable because it reaches levels unseen since the early 2020s. The U.S. last confronted such strong price increases in the initial aftermath of the pandemic, when pent-up demand and supply disruptions caused inflation to spike to multi-decade highs. By mid-decade, inflation had been expected to normalize, but it remains high due to new challenges like the energy shock from the Middle East conflict. Economists draw parallels to the 1970s stagflation era when oil shocks contributed to persistently high inflation and slower growth. Though there are key differences today, such as more anchored inflation expectations and a less energy-intensive economy. Nonetheless, the specter of inflation running above target raises memories of past episodes where controlling it required painful measures. The Federal Reserve's current tightening cycle, which has already seen the policy rate rise well above pre-pandemic levels, underscores how seriously today's inflation is being taken, and whether more action is needed will depend on upcoming data. Subtopic: Policymaker responses to inflation. This unexpected spike in inflation is prompting swift reactions from policymakers. The Federal Reserve, facing an inflation rate stubbornly above its 2% target, is under pressure to adjust its forward guidance. During its last meeting, the Fed held interest rates steady to assess conditions, but with prices now heating up again, internal divisions are apparent. In April's meeting, 4 Fed officials dissented, the most since 1992, underscoring growing debate on how to balance inflation risks with economic growth concerns. Fiscal policymakers are also taking note. Rising prices can erode the impact of government spending and become a political issue. Globally, other central banks, like the European Central Bank and Bank of England are similarly balancing high inflation with weakening growth, delaying cuts, and preparing to tighten policy further if necessary. These responses highlight a common theme: the fight against inflation is not over, and the policy stance remains oriented towards tempering price pressures even if it means restraining economic expansion in the short term. 3. Stock markets hit record highs amid earnings strength and AI optimism. Paragraph 1. U.S. stock markets have surged to all-time highs, capping a remarkable rally fueled by a potent mix of strong corporate earnings and excitement over new technologies. The Dow Jones Industrial Average, S&P 500, and Nasdaq Composite indices have each notched record levels in recent sessions, defying earlier concerns about rising interest rates and geopolitical uncertainty. April's performance was particularly astonishing. The S&P 500 jumped over 10% in April, marking its best month since 2020, and closed above 7,200 points for the first time ever by month's end. Market sentiment has been buoyed by robust first-quarter earnings across multiple sectors, which significantly exceeded analysts' expectations. High-profile companies in technology, finance, and industrials delivered double-digit profit gains year over year, reinforcing investor confidence that corporate America can thrive despite economic headwinds. As a result, Wall Street has been infused with optimism, with many traders shrugging off near-term worries and driving stock prices to unprecedented heights. Paragraph 2. Technology and artificial intelligence, AI, stocks have been the standout leaders of this rally, often referred to as the Magnificent Seven, a group of mega-cap tech giants, powering much of the market's year-to-date gains. Companies like Apple, Microsoft, Google, Alphabet, Amazon, Nvidia, Tesla, and Meta have seen their stocks soar, with some posting record-setting monthly advances following upbeat earnings. For example, Alphabet's share price skyrocketed more than 30% in April after strong results from its cloud and advertising businesses, marking its best monthly gain in over 2 decades. Investors are enthusiastically rewarding any hint of AI-driven growth, as evidenced by rising valuations for companies announcing big investments in artificial intelligence. This momentum has become self-reinforcing. As a handful of tech leaders climb, they lift market indices that are weighted heavily toward these giants, which in turn fuels further bullish sentiment among traders and retail investors. The result is a narrow but powerful rally concentrated in technology names that has sent the broader stock market rallying alongside it. Paragraph 3. Despite the euphoria, a chorus of analysts is cautioning about high valuations and potential fragility beneath the surface of this rally. The S&P 500's cyclically adjusted price-to-earnings ratio, the Shiller P/E, has climbed into the low 40s, approaching levels last seen at the peak of the dot-com bubble in 1999. Many of the recent gains have been concentrated in those few tech megacaps, while more economically sensitive stocks and smaller companies have lagged. HSBC and other investment banks have noted that market breadth is relatively narrow, meaning the rally is not broad-based. Some forecasting firms have raised their year-end targets for the S&P 500, with a median target around 7,650, implying modest single-digit further upside, but they caution that the market's climb is built on expectations of strong earnings growth continuing. Elevated valuations leave little margin for error. Any disappointment in earnings or escalation in risk factors, like interest rates or geopolitical tensions, could trigger a sharp correction. For now, Wall Street's prevailing mood is bullish, but it is balanced by acknowledgement of downside risks lurking amid the market's lofty heights. Subtopic: April's best month since 2020. April was a blockbuster month for U.S. equities, providing much of the momentum that has carried markets to new highs. The S&P 500 soared over 10% for the month, its strongest monthly performance since the big rebound in 2020. Similarly, the tech-heavy Nasdaq Composite recorded multiple record closing highs as technology shares surged, particularly during earnings season. A wave of better-than-expected first-quarter earnings acted as a catalyst, as one company after another beat profit forecasts. The rally's backdrop, steady but not worsening geopolitical tensions and a pause in interest rate hikes, also gave investors confidence to push prices higher. By the end of April, stocks had fully recovered from earlier year volatility, and investors were euphoric. Analysts noted that solid fundamentals like strong earnings justified some of the gains, although they remain mindful that this kind of rapid ascent can be hard to sustain without occasional pullbacks. Subtopic: Tech titans lead the charge. The stock market surge has been dominated by technology giants, which are capturing outsized portions of the year's gains. The so-called Magnificent Seven, a cohort of the largest tech companies, together account for a huge share of the S&P 500's increase. These companies are benefiting from investor enthusiasm around AI and cloud computing with many announcing major initiatives in machine learning, advanced semiconductors, and new software services. For instance, Alphabet stock soared by more than a third in April, propelled by robust earnings and optimism around its AI projects and cloud revenue growth. Chipmaker Nvidia has also surged year-to-date, reflecting massive demand for its AI hardware. The market's heavy concentration in a few high-flying tech stocks means the overall indexes are more sensitive than ever to these companies' performance star. Investors are closely watching each earnings report and product announcement from these tech behemoths, aware that a stumble by any one of them could quickly stall the broader rally. Subtopic: Record valuations and bubble warnings. By early May, U.S. stocks were trading at historically rich valuations, causing some market veterans to whisper comparisons to the late 1990s tech bubble. The Shiller P/E ratio, a long-term valuation measure, soared above 42, only a hair below its record high during the dot-com era. This suggests that investors are paying nearly 42 times the average inflation-adjusted earnings of S&P 500 companies, a level that implies high expectations for future profit growth. Bulls argue that today's profitable tech giants justify higher valuations thanks to real earnings and revolutionary technologies like AI. However, skeptics warn that no matter how promising the future, asterisk stocks cannot outrun fundamentals indefinitely. The risk is that if interest rates remain high or earnings growth slows even slightly, asterisk prices could come down sharply. Some analysts caution that asterisk pockets of irrational exuberance may be forming, particularly around AI and next-generation tech, and they encourage investors to remember the painful lessons of past bubbles bursting. In essence, the current market optimism is tempered by the awareness that trees don't grow to the sky, and that markets may need to catch their breath. Subtopic: Narrow market breadth raises fragility concerns. One hallmark of this rally is its narrow market breadth, meaning a relatively small number of stocks are doing much of the heavy lifting. In fact, while major indices hit records, many smaller and mid-sized stocks have not kept pace, and some remain below their highs. This divergence is causing some strategists to worry that the rally could be easily derailed if the leading stocks falter. Financial experts like those at HSBC and JP Morgan have raised their near-term S&P 500 targets modestly upward, yet also flagged that much of the index's success rests on continued strength in a few sectors. Ideally, a healthy bull market sees a wide range of companies and industries moving up together, reflecting broad economic strength. The current situation, with the rally leaning heavily on tech, could reverse if investor sentiment toward those handful of stocks changes. Thus, while many enjoy the market's climb, they're also mindful that a top-heavy market can be more prone to volatility if investor preferences shift or if a negative catalyst emerges in one of those crucial sectors. Subtopic: Earnings growth expectations underpin optimism. Wall Street's bullish outlook isn't based purely on hype. It's also grounded in rising forecasts for corporate earnings. After an impressive start to the year, analysts now predict S&P 500 earnings per share, EPS, growth of roughly 14% to 20% in 2026 *, a significant acceleration from the prior year. Companies have demonstrated remarkable earnings resilience and even expansion in the face of challenges like high inflation and shifting consumer demand. The strong Q1 results across sectors, from tech to finance to consumer goods, have led many forecasters to raise their profit estimates for the full year. In turn, some prominent market strategists, including veterans like Ed Yardeni, have hiked their year-end S&P 500 targets into the *7,600 to 8,200 range *, which would mean further gains by December if achieved. The consensus among large banks and research firms is that if current trends hold, U.S. equities can continue delivering solid returns especially if new technologies keep boosting productivity and earnings. This optimism supports the market's current momentum, though it assumes no major shocks will derail growth. Subtopic: Risks that could trigger a pullback. Even as the market marches upward, professionals are keeping watch for potential stumbling blocks that could interrupt the rally. Geopolitical tensions, notably the ongoing issues in the Middle East, are a constant overhang, since an escalation could further spike oil prices and hurt corporate margins. Inflation surprises are another risk. If price pressures continue rising beyond expectations, central banks worldwide may have to tighten policy more than currently foreseen, which historically leads to market volatility or corrections. There's also the specter of a mid-year market correction *, which some strategists note is common after an extended rally. Elevated valuations mean stocks might react strongly to any disappointing news, whether it's weaker consumer spending, an earnings miss by a major tech name, or a shift in Federal Reserve tone. Investors are advised to stay vigilant balancing their optimism with awareness of these vulnerabilities, as the line between a roaring bull market and an overheating one can be thin. Subtopic: Global equities join the rally. This bull run isn't confined to the United States. Global equity markets have risen dramatically in tandem, reflecting widespread investor optimism. The MSCI All Country World Index jumped over 10% in April, indicating that stock markets around the world are moving higher. Emerging markets led the charge with an eye-popping 14% gain for the month as investors poured money into riskier assets globally. Developed international markets also notched strong advances, though somewhat less explosive than the US and emerging Asian markets. This synchronized climb can be traced to many of the same drivers upbeat earnings, hopes that central banks are nearing the peak of their tightening cycles, and excitement over technological innovations that could boost productivity worldwide. However, global markets face their own complexities. Some developing countries are grappling with inflation from high fuel import costs and currency volatility due to the strong US dollar. While the overall global rally speaks to a risk-on mood, international investors are mindful that conditions can diverge quickly across regions if local problems flare up, even amid this broad uptrend. 4. SpaceX prepares for the largest IPO in history. Paragraph 1. The financial world is abuzz with excitement as SpaceX, Elon Musk's private space exploration company, prepares to go public in what could be the largest initial public offering, IPO, ever. SpaceX has reportedly filed confidential paperwork with regulators, aiming for a potential valuation of $1.50 to $1.75 trillion, a staggering figure that would dwarf all previous IPOs, including Saudi Aramco's record-breaking 2019 listing. If SpaceX raises the expected $30 to $50 billion or more in this offering, it will set an unprecedented milestone on Wall Street. Investors have been eagerly anticipating a SpaceX IPO for years, captivated by the company's revolutionary achievements in reusable rockets, satellite internet, Starlink, and plans for missions to Mars. Now that this long-awaited debut is imminent, analysts are debating how the market will absorb a listing of such scale. The anticipation of this giant IPO has contributed to the broader market's bullish mood, reflecting investor appetite for high-growth, visionary companies even in a volatile global climate. Paragraph 2. The planned SpaceX IPO highlights the confluence of technology, innovation, and capital markets in 2026. SpaceX's rumored valuation around $1.5 trillion underscores how high the market's expectations are for its future growth and profitability. The company has transformed spaceflight by drastically reducing launch costs, securing lucrative contracts, including NASA's astronaut missions, and deploying a mega-constellation of internet satellites that generates significant revenue. Its success has turned it into one of the world's most valuable private companies, and going public will allow a wider group of investors to share in SpaceX's journey. The timing of this IPO in mid-2026 is notable. It comes during a period of investor euphoria around breakthrough technologies like space and AI, and when stock indices are near all-time highs. That environment bodes well for a warm reception, but some observers wonder if such lofty valuations are sustainable in the face of rising interest rates and economic uncertainties. Paragraph 3. Market analysts are split on how the SpaceX IPO might play out. Bulls argue that SpaceX's unique position, a leader in commercial space launch and satellite networking, justifies a massive valuation given its strong competitive moat and potential to dominate new markets like space-based internet and human space travel. They point to robust demand in both private and public sectors for SpaceX's services, which could drive years of growth. On the other hand, skeptics note that a $1.5+ trillion valuation implies enormous future profits, and they caution about execution risks in the uncharted territory of space ventures. The company's financial details remain largely under wraps, though there are reports it has achieved consistent launch profitability and expects hefty revenue growth from its Starlink service. Regardless of these debates, the upcoming IPO is expected to attract global investor attention. Many see it as a symbol of the current era's risk appetite, and its success or struggles will likely send signals about the broader market's appetite for high-risk, high-reward tech investments. Subtopic: Unprecedented valuation and fundraising. SpaceX's IPO is eyeing a valuation of roughly $1.50 to $1.75 trillion, putting it in a league of its own. No company outside of Saudi Aramco has come close to such a market capitalization at debut. SpaceX's fundraising target, reportedly $30 to $80 billion, would asterisk shatter records for capital raise star. For context, the largest U.S. IPO to date was Alibaba's 2014 offering, which raised $25 billion, and even Saudi Aramco's record was around $29 billion. SpaceX's offering could comfortably top those figures, reflecting asterisk investor hunger for transformative companies star. Market experts note that achieving this lofty valuation would rely on optimistic projections of SpaceX's future revenue, particularly from its Starlink satellite internet business and potential space tourism or interplanetary endeavors. Asterisk the sheer scale of the deal means many institutional investors are keen to secure an allocation asterisk, expecting that initial trading could see a significant surge if demand outstrips supply. Still, some caution that such enormous deals can be a double-edged sword, absorbing liquidity from other areas of the market and sometimes asterisk marking a peak in market fervor if investor enthusiasm later cools. Subtopic: SpaceX's business and revenue drivers. SpaceX has become a dominant force in space technology, with multiple revenue streams fueling its rise. The company is best known for its Falcon 9 rockets, which have dramatically cut the cost of launching satellites and cargo by being partially reusable. This efficiency has earned SpaceX billions in launch contracts from commercial clients and governments alike. Another major pillar is Starlink, a satellite internet venture that already serves millions of customers globally with high-speed broadband from space. This service could be a cash cow, potentially generating tens of billions in recurring annual revenue if it scales. SpaceX is also developing the Starship, an advanced rocket designed for missions to the Moon and Mars, which could open up future revenue from space transportation and exploration. Taken together, these businesses give SpaceX a unique growth narrative, bridging aerospace and telecommunications in a way no other company has. The IPO would allow SpaceX to raise capital for these ambitious projects, fueling the next phase of expansion and cementing its financial future. Subtopic: Investor hype and market implications. The buzz around the SpaceX IPO is symptomatic of the strong investor appetite for high-growth technology plays in today's market. The mere confirmation that SpaceX was preparing to go public ignited speculation and excitement in both Wall Street circles and among retail investors on social media. Many are eager to invest in what they see as the future of space infrastructure and satellite communications. This enthusiasm is part of a larger trend. Despite high interest rates and global uncertainties, investors are flocking to growth stories tied to transformational technologies, from space travel and electric vehicles to artificial intelligence. If SpaceX's debut is as successful as expected, it could further galvanize the IPO market, encouraging other large privately held tech companies to consider listings to capitalize on favorable sentiment. However, some analysts warn that extreme hype around IPOs can signal froth in the market. They recall historical episodes where record-setting IPOs sometimes preceded market corrections. As such, the performance of SpaceX's stock post-IPO will be closely watched as a barometer of the market's risk tolerance. Subtopic: Risks and challenges facing the SpaceX IPO. While investor excitement around SpaceX is sky-high, the company's public offering also comes with significant risks and uncertainties. One issue is the asterisk execution risk of SpaceX's ambitious projects. Developing Starship for interplanetary travel and ramping up Starlink are capital-intensive endeavors still in progress, and delays or setbacks could impact revenue projections. Additionally, market conditions can change quickly. Should geopolitical tensions worsen or interest rates rise further, investor appetite for mega-sized tech IPOs could diminish by the time SpaceX completes its IPO process. There's also the matter of SpaceX's corporate governance, as some institutional investors may be cautious about the influence of CEO Elon Musk who is also leading other major companies, like Tesla, and known for his unconventional management style. Pricing the IPO correctly will be another challenge. If priced too high, the stock could struggle to rise, but if underpriced, it leaves money on the table. Despite these concerns, most signs point to a tremendous demand for SpaceX shares, reflecting how the firm has captured imaginations and convinced many that it can fundamentally reshape industries, making its IPO a landmark event for the financial markets. Subtopic: IPO as a signal of market sentiment. The SpaceX offering is being seen as a bellwether for market sentiment in mid-2026. A successful launch, with stocks surging and sustaining high valuations, would indicate that investors remain confident and risk-seeking despite macroeconomic headwinds. It would echo the current environment of abundant liquidity for technology and growth sectors. On the contrary, any stumble in the SpaceX IPO process, such as weaker-than-expected demand or post-IPO underperformance, would reverberate across the tech sector and broader market. It might suggest that even enthusiastic markets have limits to their appetite for lofty valuations, especially if interest rates remain high. Some funds could rotate money out of other assets to participate in this IPO, potentially sapping liquidity from smaller stocks in the short term. Regardless, the SpaceX listing is a defining moment that goes beyond just one company. It encapsulates the era's hallmark of bold innovation meeting equally bold investment risk-taking. Market historians will likely look back at the SpaceX IPO as a key pivot, either a triumphant confirmation of tech's dominance or a peak of exuberance that needed subsequent digestion. Subtopic: Tech IPOs and Market Revival. SpaceX's move to go public comes amid signs of a revival in the IPO market more broadly. After a couple of years of relatively subdued IPO activity due to economic uncertainty and high interest rates, Q1 saw a rebound in companies going public, including smaller tech and biotech firms. SpaceX's gargantuan offering might open the floodgates for more high-profile IPOs that were waiting on the sidelines for stable market conditions. If investors enthusiastically embrace SpaceX, it could embolden other major startups and tech unicorns to test public markets, further boosting capital markets activity. This dynamic is positive for investment banks and the financial sector, which stand to earn substantial fees from underwriting these deals. It also provides fresh opportunities for investors to tap into fast-growing companies. However, a big surge of IPOs must be balanced carefully. An excess of new offerings could strain market liquidity and investor budgets. Still, with SpaceX leading the charge, 2026 is shaping up to be a banner year for IPOs, a clear sign that public market confidence has strongly rebounded from the slowdown of previous years. Subtopic: Stock market context for the SpaceX debut. SpaceX's IPO is set to land on an already heated stock market, which is both an opportunity and a potential hazard. On one hand, rising markets are generally conducive to successful IPOs. When stocks are up and investors are in a buying mood, new listings often fare well. On the other hand, some observers worry that the combination of record-high indexes and the largest IPO ever may signal a euphoric peak star. The stock market's resilient performance despite global issues suggests a robust risk appetite, but that can shift quickly if something undermines confidence. A huge IPO like SpaceX's will test the market's depth. Do investors have enough capital and enthusiasm to absorb such an offering without distorting prices? Market participants are confident but cautious. A strong debut for SpaceX would reinforce the bullish narrative of 2026, while any trouble might spark introspection about valuations. Either way, the SpaceX IPO is more than just a single company's story. It's a measure of how far and how fast this bull market can go. 5. Big banks post record profits in Q1, but sound caution on economic risks. Paragraph 1. America's largest banks have wrapped up an exceptionally strong first quarter, collectively delivering better than expected profits as business rebounded across nearly all divisions. The likes of JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Goldman Sachs, and Morgan Stanley all beat analysts' earnings estimates, with several reporting record or near-record revenues. For instance, JP Morgan posted a jaw-dropping $16.5 billion in net income on over $50 billion in revenue for Q1, a performance that far surpassed forecasts. Investment banking, which had been sluggish in 2025 amid market volatility, roared back with double-digit increases in fees as deal-making and stock offerings regained momentum. Trading divisions also thrived on heightened market volatility, particularly in fixed income and commodities, as global economic uncertainty spurred heavy bond and derivatives trading. The overall picture is a banking industry on solid footing, with well-capitalized balance sheets and robust performance across consumer banking, corporate lending, and market-facing businesses. These results underscore that the financial sector's health in early 2026 was much more resilient than some had feared. Paragraph 2. Despite the impressive profits, bank executives struck a cautious tone about the road ahead, highlighting a tale of two economies and rising macroeconomic uncertainties. JP Morgan CEO Jamie Dimon lauded his bank's strong results but also pointed to the increasingly fragile global backdrop, including unsettling factors like elevated oil prices, a U.S.-Iran conflict affecting global trade routes, and the unpredictable path of Federal Reserve policy. Bank leaders emphasized that the volatility boosting trading profits is a symptom of risks, such as inflation pressure and geopolitical conflict, that could eventually hurt borrowers and slow economic growth. Several CEOs noted that while higher-income consumers and large corporations remain in solid shape, there are signs that lower-income households are under strain, resorting to credit cards and loans to cope with rising living costs. This divergence in consumer health is a warning sign that economic stress may be building beneath the surface. Paragraph 3. Looking into the rest of the year, these financial giants are carefully managing their expectations. Forward guidance was tempered in their earnings calls, with many bank CFOs and CEOs highlighting uncertainties. Inflation risk was a common theme. Citigroup's leadership explicitly flagged that persistent inflation could become a greater threat to growth, a sentiment echoed by others who worry that rising prices and interest rates might eventually hit loan demand and credit quality. Another shared concern was the war-driven volatility in energy markets. If oil prices stay high or climb further, it could erode consumers' spending and corporate profits, raising credit risks for banks' loan portfolios. Notably, the International Monetary Fund's latest outlook reduced its global growth forecast to around 3.1%, citing the Middle East conflict's impact on energy costs and the potential headwind to global growth. Bank executives, while pleased with Q1's results, are preparing for potential headwinds, including the possibility that the Federal Reserve may keep interest rates higher for longer, which could slow the economy. The consensus among these financial leaders is that caution is warranted, even as they continue to leverage strong balance sheets to navigate the uncertain environment. Subtopic: JP Morgan's blockbuster quarter. JP Morgan Chase, the nation's largest bank, set the tone for the financial sector's strong quarter with asterisk record-breaking results star. The bank's Q1 profits surged to $16.5 billion, propelled by asterisk robust performance across its divisions asterisk, including an $11.6 billion windfall from its markets and securities services due to lively trading in bond and equity markets. Asterisk investment banking fees rebounded 28% as IPOs and mergers picked up from last year's lull, showcasing JP Morgan's ability to capitalize on renewed corporate activity. Yet CEO Jamie Dimon didn't celebrate without caveats. He used the earnings call to warn of what he sees as a nonsensical regulatory environment and an increasingly fragile global economy star. Dimon cited the backdrop of asterisk high oil prices, a U.S.-Iran conflict that's unsettled markets, and significant uncertainty around Federal Reserve policy as factors that, while boosting volatility in the short run, and hence some trading revenue, also pose structural risk star. JP Morgan's message was clear asterisk the bank can thrive in tough conditions asterisk, but those very conditions could turn and require vigilance to navigate judiciously. Subtopic: Capital markets resurgence boosts Wall Street banks. Morgan Stanley and Goldman Sachs also delivered standout quarters, largely thanks to revived capital markets activity. Morgan Stanley saw a 36% leap in investment banking revenue, hitting $2.1 billion for the quarter as M&A deals and underwriting, stock and bond issuance, came roaring back. The firm's wealth management business notched record revenues of $8.5 billion due to rising asset values and strong client engagement. Goldman Sachs similarly experienced a boom in trading, particularly in equities, where volatile markets drove record-level revenues in that segment. In both cases, executives noted that institutional clients were actively repositioning portfolios amid the uncertain geopolitical and interest rate backdrop, which led to elevated trading volumes and fee generation. However, they acknowledged this dynamic is cyclical and event-driven. The same volatility boosting profits could reverse when markets calm, so these record numbers may not be easily repeatable quarter after quarter. For now, the big investment banks are enjoying a windfall, but they remain aware that the factors driving it are beyond their control and could dissipate. Subtopic: Consumer banking trends and credit quality. Bank of America and other consumer-focused banks highlighted the resilience of U.S. customers in Q1, but with some important caveats. Bank of America reported a better-than-expected profit of $8.6 billion, aided by steady consumer spending and borrowing. CEO Brian Moynihan noted signs of a resilient American economy, with continued outlays by consumers and businesses. However, detailed look at consumer finances suggests a split. Higher-income Americans continue to spend, while lower-income households are increasingly relying on credit to manage expenses amid higher prices. The banks reported that credit card balances remain elevated and delinquencies, while still low historically, have started creeping up among more financially stretched borrowers. Credit quality across the big banks was notably better than many expected. Delinquency and default rates did not spike in Q1, thanks to strong employment, but bankers are watching this metric closely. It appears that the financial health of American consumers is diverging, which could presage headwinds for credit if inflation and high interest rates persist throughout the year. Subtopic: Beige Book Insights and Economic Signals. The Federal Reserve's April Beige Book report, which compiles observations from businesses across regions, echoed some of the cautious notes from bank CEOs. It indicated that consumer spending had increased slightly overall, but lower-income households were reducing expenditures because of rising energy and living costs, aligning with the bank's commentary. Business leaders reported growing uncertainty about the future, a shift from more optimism seen in earlier months. The Beige Book also highlighted that, despite strong job growth, many firms had moderated their hiring expectations due to worries about where the economy is heading. This context suggests that even though banks thrived in Q1, they are realistic about a potentially bumpier path ahead in Q2 and beyond, especially if consumers and businesses tighten their belts. Subtopic: Inflation and energy concerns from bank CEOs. A recurring theme in big bank earnings calls was concern over inflation and energy prices. Several top executives flagged that if inflation remains elevated, as recent data suggests, it could hinder economic growth and loan performance later in the year. Citigroup's leadership explicitly noted that mounting price pressures, especially if compounded by persistent oil supply disruptions, pose a longer-term threat to consumer purchasing power and corporate profit margins. Oil's run-up to over $100 per barrel because of Middle East tensions was frequently mentioned as a wildcard that could slow economic activity and increase credit risk. If inflation forces the Fed to keep rates higher for longer, loan demand could cool and some borrowers might struggle, a scenario banks are modeling out in stress tests. Thus, behind the scenes of glowing Q1 reports, banks are stress testing their portfolios for what-if scenarios that involve stubborn inflation, protracted high rates, or even potential recessions, to be prepared for any adverse turn. Asterisk subtopic: IMF's warning and growth outlook. The optimism of strong bank earnings is tempered by cautionary notes from global economic authorities. The International Monetary Fund, IMF, in its latest World Economic Outlook lowered its 2026 global growth forecast to around 3.1%, down from prior projections. This revision is primarily due to the expected impact of the Middle East conflict on energy prices and supply, which could act as a drag on economic activity worldwide by fueling inflation. Bank executives referenced such global outlooks to remind investors that, despite their robust quarter, the macro environment is uncertain. With global growth slowing and inflation elevated, the ability of households and businesses to keep spending and borrowing at recent levels might diminish. This aligns with the cautious stance many banks are taking, strong capital positions, and contingency plans to weather a variety of macroeconomic outcomes in the next few quarters. Asterisk subtopic: Investors focus post-earnings. With the Q1 earnings season largely behind them, bank stock investors are now turning their focus to a few key indicators. Oil prices top the list. If they stabilize or recede, it could alleviate some inflationary pressure, but if they spike further on geopolitical news, worry will grow about an economic slowdown. Federal Reserve signals will also be crucial. A hawkish tone from the new Fed chair, Kevin Warsh, could both help banks' net interest margins and simultaneously raise worries about recession. Investors are watching M&A and capital markets activity, a major driver of Q1 results, to see if the rebound in deals and IPOs persists into Q2 or fades. There is a sense that the first quarter may have been an exceptional period capturing a lot of pent-up activity. The banks themselves have not changed their cautious messaging despite the strong quarter, which suggests financial markets should brace for volatility ahead rather than assume the good times will simply roll on unimpeded. 6. Regulatory reforms poised to unleash bank lending and growth. Paragraph 1. Major U.S. bank regulatory changes are on the horizon and could free up hundreds of billions of dollars in capital, according to industry analysts. The Federal Reserve and other bank regulators are circulating proposals, including adjustments to capital rules like the Supplementary Leverage Ratio, SLR, and tweaks to global bank capital standards, Basel III, that would reduce some of the most stringent post-2008 restrictions on bank balance sheets. Morgan Stanley's research indicates that currently, large American banks hold about $175 billion in capital above regulatory minimum requirements, largely due to conservative rules implemented after the last financial crisis. If new reforms are adopted, these excess reserves could swell to between roughly $212 billion and $279 billion over the next few years. This unlocked capital could be channeled into increased lending and other market activities, providing additional fuel for economic growth. Bank stocks have responded positively to signs of a friendlier regulatory environment, as investors anticipate the potential for banks to deploy more capital for loans, stock buybacks, and expansions, thereby enhancing profitability. Paragraph 2. These potential regulatory reforms benefit banks by allowing them more flexibility in how they use their capital. Under current rules, major banks must keep substantial equity buffers to meet risk-based and leverage requirements. This has kept a large chunk of capital essentially idle, earning minimal returns. Easing these rules would enable banks to put more money to work. The expectation is that some of this freed-up capital will be directed towards boosting business and consumer lending, supporting economic activity by meeting pent-up credit demand. Banks are also likely to increase their involvement in capital markets, underwriting more debt and equity offerings, as global deal-making and IPOs have seen a recent resurgence. Another outcome could be more share buybacks and dividend increases, as banks return excess capital to shareholders. In a base case scenario, bank earnings per share could increase by mid to high single-digit percentages above current forecasts by the late 2020s, bolstering valuations. Paragraph 3. The push for regulatory relaxation comes partly from shifting political winds in Washington. The current administration has signaled a desire to foster growth by streamlining regulations, aligning U.S. rules more closely with global norms to help American banks remain competitive. Among the changes being considered are revisions to the Global Systemically Important Bank (GSIB) surcharge formula and a finalization of the so-called Basel III Endgame rules in a less restrictive form. If enacted, these changes would mark a partial rollback of the strict capital regimes put in place after the 2008 financial crisis and refined after 2020, reflecting a belief that banks are now strong enough to operate with slightly lower capital cushions. Critics caution that loosening capital requirements too much could reintroduce systemic risks, but so far the focus is on modest adjustments that still maintain safety. The developments suggest upsides for bank profitability and lending capacity, giving the financial industry a reason for guarded optimism even as they remain vigilant about macroeconomic conditions. Asterisk subtopic: excess capital on bank balance sheets. Large U.S. banks have built up significant excess capital, the difference between their actual capital and the regulatory minimum required. After more than a decade of tight regulations, these banks are sitting on an estimated $175 billion of capital above what rules demand, essentially in used capacity that could cushion against losses or finance new business. Proposed regulatory changes aim to recalibrate these requirements, potentially recognizing that current rules are overly conservative given improvements in risk management and profitability. If regulations are eased, banks' excess capital could grow by another $40 to $100 billion over the next couple of years, according to bank analysts. This pool of capital can then be strategically utilized, for example, to fund new lending in commercial and consumer markets, to expand trading operations, or to repurchase shares. The prospect of unlocking so much additional funding is a key reason bank stocks have been relatively strong performers recently, even as some other sectors worry about rising interest rates. Investors see a future where banks can turn idle capital into earnings asterisk, boosting shareholder returns while still maintaining prudent buffers. Subtopic: Lending and Economic Growth Potential. One direct impact of freer regulatory capital could be a significant uptick in lending. Banks have been somewhat constrained in growing their loan books due to stringent leverage rules that cap how much they can lend relative to equity. With reforms, banks like JP Morgan, Bank of America, and Citigroup would gain headroom to extend more credit to businesses and consumers. This comes at a timely juncture. Many companies are seeking loans to fund expansions, and consumers still have credit needs, especially with personal budgets stretched by inflation. Banks deploying additional capital into loans could boost economic growth, providing the funds for companies to invest and hire, and for households to spend on big purchases like homes or cars. Bank executives are already signaling readiness to lend if given the green light, noting pent-up client demand for credit in sectors like commercial loans and real estate. Economists note that careful monitoring is key. While more lending can stimulate growth, regulators must ensure banks don't lower standards in a way that adds undue financial risk. Subtopic: Capital Markets and Deal Activity. Beyond traditional lending, banks stand to benefit in their capital markets operations if they can allocate more resources to underwriting and trading. The past quarter saw a 40% surge in global merger and acquisition (M&A) volumes and a pickup in initial public offerings, after a lull in previous years. Banks have been eagerly waiting for such an upturn. These activities generate hefty fees. With loosened capital rules, banks would have more flexibility to commit funds for things like M&A bridge loans, which temporarily finance big acquisitions, or for underwriting large IPOs like the anticipated SpaceX listing. More capital means banks can participate in bigger deals and hold more securities on their trading books, potentially boosting their revenue from market making and structured products. The regulatory relief could thus amplify banks' ability to capitalize on the currently vibrant deal environment, reinforcing their role as intermediaries in the capital markets and further supporting the economic cycle of investment and growth. Subtopic: Shareholder Returns and Bank Valuations. If excess capital is freed, banks could increase shareholder payouts, such as stock buybacks and dividends, as they did in the late 2010s when regulations were eased. Many banks have been cautious with buybacks recently to conserve capital amid economic uncertainties. But with regulators possibly loosening the reins, banks may resume larger capital return programs, which tends to boost their stock prices. Analysts at Morgan Stanley project that by 2027, bank earnings per share could be 6% or more above current consensus if these regulatory changes permit capital deployment as expected. By 2028, that boost could reach around 8% above current forecasts. This scenario underpins a bullish case for bank stocks, with some projecting potential 25% upside for bank share prices in the next couple of years, assuming a supportive regulatory environment and successful capital deployment. It's a welcome development for a sector that has often underperformed the broader market since the financial crisis, and one that could drive renewed investor interest in bank equities. Subtopic: Reform Details, SLR, G-SIB, and Basel Endgame. The reforms in question revolve around key banking regulation metrics. One is the Supplementary Leverage Ratio, SLR, a broad measure of bank leverage, which was tightened in 2020. Regulators are now considering adjustments that may exclude certain low-risk assets like reserves and treasuries from the calculation, effectively raising the allowed leverage. Another element is the Global Systemically Important Bank, G-SIB, surcharge, and extra capital requirement for megabanks. Changes here could slightly reduce the additional capital big banks need to hold. Lastly, the Basel III Endgame. The final set of international banking rules is being tailored to U.S. conditions, potentially in ways that lighten capital burdens. Together, these tweaks are aimed at harmonizing U.S. rules with global norms and reflecting lessons learned. The primary goal is to enable banks to operate more efficiently and support the economy while still maintaining a robust safety net. Bank lobbyists have welcomed these moves, arguing that the current regime had constrained credit. However, some experts urge caution, emphasizing that regulators must balance growth with the need to prevent excessive risk-taking. Subtopic: Political backdrop of deregulation. The push for regulatory changes in 2026 is happening against a politically charged backdrop. President Trump's administration, which took office in early 2025, has made regulatory reform in banking a central priority, aiming to roll back what it views as overly burdensome rules that hinder economic expansion. This direction aligns with the administration's pro-business stance and desire to accelerate growth. Critics argue that loosening bank regulations, even modestly, can increase systemic risk, and memory of the 2008 crisis remains fresh for many policymakers. However, the reforms under discussion are targeted and incremental rather than wholesale deregulation, focusing on technical adjustments to capital calculations. Lawmakers and regulators supporting the changes believe that the banking sector's stability and oversight remain robust with these adjustments, and that unleashing some of this locked capital will benefit the economy. The political calculus is that a well-capitalized banking sector can safely take on more risk now, given improved risk management and oversight, thereby fueling lending and investment in an economy that faces headwinds from other areas like high interest rates and volatile markets. Asterisk subtopic: Global comparisons. Efforts to tweak U.S. banking rules also mirror a broader global trend in financial regulation. In Europe, regulatory adjustments have been more gradual, as the European Central Bank remains cautious amid an uncertain economy. However, European banks have also been advocating for relief, especially as they contend with economic headwinds. Some emerging markets are at an earlier stage of bolstering bank capital and regulation, learning from the developed world's experience. In China, regulators are balancing tight control over the financial sector with a desire to use banks to stimulate growth as needed. Japan and UK authorities likewise periodically adjust their own capital frameworks. The overarching narrative is that more than a decade after the financial crisis, regulators worldwide are fine-tuning rules, sometimes easing, sometimes tightening, to strike a balance between stability and growth. The U.S. appears to be taking a moderate step toward flexibility in 2026, a move that may influence international peers if it indeed promotes sustainable bank-led growth without compromising financial safety. 7. Global economic outlook wavers amid inflation and geopolitical strains. Paragraph 1. The global economic landscape is entering a period of heightened uncertainty as forecasts and sentiment begin to reflect the dual challenges of persistent inflation and geopolitical conflicts. The International Monetary Fund, IMF, released its latest World Economic Outlook update this week, trimming the projected global growth rate for 2026 to around 3.1%, a slight downgrade reflecting caution about the months ahead. The IMF has pointed to emerging risks, particularly surging energy prices due to Middle Eastern conflict and signs of slowing momentum in key world economies. At the same time, synchronized stock market rallies worldwide have contrasted with the more somber macroeconomic indicators, suggesting that financial markets may be more optimistic than some economic fundamentals justify. The backdrop for the global economy features elevated inflation not only in the U.S. but also in Europe and parts of Asia, threatening to erode consumer purchasing power and corporate margins worldwide. As a result, global policymakers and investors are grappling with a complex picture. On one hand, major economies are growing, but on the other hand, that growth is uneven and accompanied by headwinds that could gather strength as the year progresses. Paragraph 2. Regional divergences are emerging in economic performance. The United States posted a robust annualized growth of 2% in the first quarter, benefiting from a burst of federal spending and surging investment in technology and AI infrastructure. In contrast, the Eurozone barely expanded, at about 0.1% growth in Q1, as Europe faces greater exposure to energy shocks and weaker domestic demand. China's economy, while expanding around 5%, is dealing with post-pandemic adjustments and a troubled property sector, keeping its growth moderate. India has been a bright spot with a resilient economy, but it now faces renewed inflation pressures and a weakening currency. Emerging markets more broadly are confronting capital outflows triggered by higher U.S. interest rates and a strong dollar. Supply chain issues and the high cost of imported commodities, from oil to food, are pressing many developing countries. These varying growth trajectories mean that some economies may have policy space to support growth, while others find themselves constrained by inflation, making a one-size-fits-all global recovery increasingly unlikely. Paragraph 3. Multiple risk factors are clouding the global outlook, prompting caution from businesses and policymakers. A key concern is the enduring geopolitical tension in the Middle East, which we discuss in detail elsewhere in this report, due to its influence on energy markets and investor confidence. Inflation remains stubbornly high in many regions, meaning central banks around the world are hesitating to provide any new stimulus and, in some cases, contemplating further interest rate hikes. Trade flows and manufacturing activity have also seen headwinds, with some global supply networks still recalibrating after pandemic-era disruptions and now contending with new uncertainties such as export controls and regional conflicts. Another worry is financial market volatility. A correction in one major market, perhaps due to a policy surprise or corporate earnings miss, could quickly spread through globally interconnected markets. Facing these uncertainties, global economic institutions like the IMF and World Bank are urging nations to prepare for potentially slower growth, calling for prudent fiscal management and collaborative diplomacy to manage shared risks. In summary, the world economy is still growing, but with old risks, inflation, high debts, meeting new ones, geopolitical conflicts, financial market froth, the current expansion is anything but assured. Asterisk subtopic. IMF lowers global growth forecast. The International Monetary Fund's revised growth projection of around 3.1% for this year indicates rising caution. This slight downward adjustment acknowledges emerging concerns like the prolonged Middle East conflict and its ripple effects on energy prices and global trade. The IMF's forecast suggests that after a post-pandemic rebound, the global economy is entering a more challenging phase where structural problems, like high debt levels and demographic shifts, intersect with acute shock star. While 3.1% global growth is not a recession, it's modest and asterisk vulnerable to downside risk star. Policymakers internationally are interpreting this downgrade as a sign that they should not be complacent. Targeted asterisk fiscal and monetary measures might be needed in weaker regions, but with a careful eye on inflation and debt sustainability. The IMF's message serves to remind the world that we are not out of the woods asterisk, and concerted action may be necessary to keep growth on track. Subtopic: Diverging performance. U.S. versus Europe. A striking feature of the global outlook is the widening performance gap between the United States and Europe. In the most recent quarter, the U.S. economy expanded at an annualized 2%, roughly 4 times the growth pace of the European Union's 0.5% annualized equivalent over the same period. The divergence stems from multiple factors. The U.S. benefited from a surge in government spending as it recovered from a late 2025 fiscal impasse, and from a massive wave of investment in AI and technology, fueling productivity and business expansion. Europe, however, has been hamstrung by energy price shocks, largely due to the conflict affecting oil supplies and sluggish domestic demand. European industries, particularly manufacturing powerhouses like Germany, are contending with higher energy costs that weigh on output and margins. The result is a scenario where America's growth is outpacing Europe's by the widest margin since the post-pandemic period began. This has direct financial effects as well. U.S. stock markets and the dollar have outperformed, while some European equities and the euro have lagged. The challenge for European policymakers is balancing inflation fighting with support for a fragile recovery to narrow this gap moving forward. Subtopic: China's steady growth and tech investments. China's economy continues to expand at a moderate but steady pace, with first-quarter growth in line with, or slightly above, expectations. The world's second-largest economy is targeting roughly 5% growth for the year, focusing on stability amid global uncertainty. One highlight is China's push to support its private sector and technological innovation. Regulatory bodies have laid out priorities for boosting private enterprise and curbing overcompetition in certain areas to bolster productivity. China is also investing heavily in advanced manufacturing and green technology, aiming to sustain long-term growth even as external challenges like weaker global trade and lingering U.S. tariffs persist. Chinese exports have shown resilience in early 2026, and domestic consumer spending is gradually firming as the country moves past pandemic-era constraints. However, pockets of weakness remain, notably in the property sector and some local government finances, which could act as drags. Global investors are keeping a close eye on China's economic signals, as its performance is crucial to overall emerging market health and commodity demand worldwide. Subtopic: Emerging markets under pressure from rising U.S. rates. Many emerging market economies are facing a challenging environment due to external factors beyond their control. One issue is the strong U.S. dollar and high American interest rates, which often lead global investors to pull back funds from riskier markets and invest more in safe, higher-yielding U.S. assets. This scenario is putting downward pressure on currencies like the Indian rupee, which is sliding toward historically weak levels against the U.S. dollar, and raising borrowing costs for many developing nations. Additionally, import-heavy economies are contending with rising prices for oil and food. Countries that rely on energy imports, such as India, Turkey, and others, see their inflation rates climbing as global oil prices remain high. The combination of capital outflows, weaker currencies, and higher import costs is a recipe for twin pressures on emerging markets. To cope, some central banks in these countries might have to raise their own interest rates or implement supportive measures, even though that can slow their domestic growth. It's a delicate balancing act as these economies try to maintain stability in the face of global headwinds emanating from advanced economies and geopolitical uncertainties. Subtopic: Global trade and supply chain challenges. International trade is feeling the strain of a world rife with uncertainty. After a strong rebound in trade volumes last year, growth in global trade has moderated due to a mix of factors: ongoing conflicts, shifting supply chain strategies. Companies are rethinking reliance on single-source suppliers after recent disruptions, and simmering trade tensions, for example, U.S.-China technology export controls. The Middle East conflict has raised shipping costs and complicated logistics for certain routes, adding to the list of obstacles. Meanwhile, supply chain bottlenecks still persist in semiconductors and key raw materials like critical minerals, partly due to heavy demand from new tech sectors and partly due to lingering post-pandemic hiccups. These challenges are contributing to slower industrial output in manufacturing-heavy regions like Europe and parts of Asia. Businesses worldwide are adopting strategies like diversifying suppliers and increasing inventory to build resilience, but these solutions can drive up costs. Global trade's performance will serve as a bellwether for whether the international economy can weather these simultaneous strains or if they will weigh further on the outlook. Subtopic: Global inflation's new dynamics. One aspect of the current global economic story is the internationalization of inflation. In previous eras, inflation was often a domestic issue linked to a country's own economy. Now, inflationary pressures are being transmitted across borders through energy prices and supply chain links. The war-driven spike in oil and gas costs has manifested in higher inflation prints from Europe to Asia. Food prices globally are also rising due to elevated fertilizer and transport costs, which is a severe issue for lower-income nations. This globalization of inflation means that central banks are facing price pressures originating from factors they don't control, such as geopolitical conflict, making their job more difficult. Traditional interest rate hikes can cool domestic demand, but cannot directly lower oil prices or fix supply disruptions. This limits the effectiveness of monetary policy on these specific inflation sources. This dynamic underscores the need for international cooperation, whether through strategic reserves usage, diplomatic resolutions to conflicts, or support for diversified supply, to address inflation that is increasingly global in nature. Subtopic: Market sentiment versus economic reality. A notable contrast in mid-2026 is the dichotomy between market optimism and economic caution. Stock markets have been exuberant, as covered in a separate topic here, often looking past short-term headwinds. Meanwhile, global economic organizations and some corporate leaders are striking a more restrained tone. Asterisk central banks are in a bind asterisk, wanting to ensure inflation doesn't spiral while hoping not to derail growth. Some investors worry that markets might be asterisk too sanguine about risks asterisk, bidding up assets even as fundamentals flash warning signs. For instance, surging oil prices and slower growth have not stopped a worldwide stock rally, raising questions of whether markets expect a best-case scenario of just right outcomes, cooling inflation without a deep recession. This mood could shift quickly if any major risk materializes beyond what markets have priced in. Thus, even as equity indices climb, a sense of caution pervades among economists and long-term strategists, emphasizing that staying informed and diversified is more important than ever in today's unpredictable global environment. 8. Oil price volatility and geopolitical tensions rattle global markets. Paragraph 1. Geopolitical conflict in the Middle East has brought oil prices back into the spotlight, sending shockwaves through international financial markets. This week, hopes for a lasting peace between the United States and Iran dimmed after diplomatic efforts faltered, leading to renewed uncertainty. Oil prices, which had surged to multi-year highs above $100 per barrel earlier in the spring, remain elevated, oscillating on every headline about ceasefires or escalations. The stakes are high. The conflict involves the Strait of Hormuz, a critical choke point through which a significant portion of the world's oil passes. Concerns that the strait could be closed or restricted, even temporarily, have boosted prices due to the risk of supply disruptions. This volatility has had immediate effects on markets. European stocks fell sharply this week, with the Pan-European Stoxx 600 sliding around 1% on a single day as investors worried that rising oil costs would dent corporate earnings and fan inflation across the region. The global energy market's tightness, with OPEC Plus producers also keeping supply discipline, means any geopolitical disruption can amplify price moves, and financial markets are reacting with caution. Paragraph 2. The repercussions of high oil prices are being felt far and wide, beyond just energy companies. In equity markets, oil-sensitive sectors like airlines, transportation, and manufacturing have seen share prices pressured as higher fuel costs threaten their profit margins. Bond markets have also responded. Yields on government bonds climbed in some regions as traders anticipated that sustained oil-driven inflation might prompt central banks to tighten interest rates further. European bond yields jumped, reflecting expectations that the European Central Bank might need to take a more hawkish stance if energy prices keep contributing to inflation. Meanwhile, oil-exporting countries have seen some economic boon. Their stock markets and currencies are drawing investors, with energy companies posting impressive revenue gains. However, the net effect globally leans negative because many economies are net importers of oil, meaning more capital flows out to pay for energy, acting as a drag on growth. The real economy impacts are significant, from higher transportation and heating costs for households to increased expenses for manufacturers, all of which can suppress consumer spending and corporate investment. Paragraph 3. Market and policy responses to the oil shock are ongoing. Many oil-importing nations are responding by tapping strategic petroleum reserves or negotiating supply adjustments to cushion their economies. Central banks are intently monitoring inflation expectations. Multiple officials have said they stand ready to raise rates if needed to prevent an oil shock from seeping into wages and long-term price setting. Investors are keeping a close eye on diplomatic developments. Any signs of a lasting resolution between the involved countries could rapidly unwind the risk premium in oil prices, sending crude sharply lower, which would likely boost stock markets. In contrast, the absence of a deal means the risk premium remains in place, possibly for months. As oil seesaws, it has become a major driver of daily market sentiment. Volatility indices have ticked up with each flare of geopolitical tensions. For now, the prospect of a prolonged conflict and persistent high energy costs has reintroduced a kind of stagflationary fear in parts of the world. The combination of slower growth and higher inflation due to energy prices evokes parallels with past crises. However, the consensus among economists is that today's economies are more resilient to oil shocks than in decades past, thanks to improved energy efficiency and diversified energy sources, suggesting that while painful, the current turmoil should be manageable if it doesn't worsen dramatically. Subtopic: European markets react to conflict and oil spike. European financial markets have been particularly sensitive to the twists and turns of the Middle Eastern conflict. Early this week, European equity indices tumbled more than 1% in a single session after U.S. officials described a ceasefire with Iran as on-life support. Investors in Europe are acutely aware of how vulnerable the region's economy is to energy price shocks, given its reliance on imported oil and gas. As news of renewed tensions broke, the Pan-European Stoxx 600 index fell by about 1.1%, and major national indexes like Germany's DAX and London's FTSE 100 also slid over 1%. At the same time, European bond yields climbed, a signal that investors fear the European Central Bank might be forced into further interest rate hikes to counter a fresh wave of inflation. Indeed, Germany's latest data showed inflation nudging up to 2.9% in April, a worrisome trend if energy costs remain elevated. European corporate news also fed into the mix. For instance, German conglomerate ThyssenKrupp cut its sales outlook for the year, blaming uncertain economic conditions, which hurt its stock and underscored the broader caution in Europe's market environment. Subtopic: Oil prices above $100 and volatility. During the past weeks, oil prices have been trading above $100 per barrel, levels not seen in several years. The volatility in crude oil markets has been striking. Prices have swung sharply depending on daily news, as hopes for peace deals alternately rise and collapse. For example, when Iran temporarily reopened the Strait of Hormuz as a goodwill gesture in mid-April, oil prices plunged about 11% in one day, offering relief. But within days, as negotiations faltered, oil surged again. Brent crude, the global benchmark, has been hovering between $110 and $120 per barrel, about 50% higher than it was before the conflict. This seesaw in oil pricing is injecting volatility into currency markets as well, with oil-importing countries seeing their currencies weaken over concerns about trade balances, while currencies of oil exporters have strengthened. The sustained period of triple-digit oil prices suggests that unless the conflict finds resolution, the global economy will have to cope with elevated energy costs for some time. Subtopic: Inflationary pressure from energy. High oil and gas prices are directly feeding into inflation worldwide. Fuel is a core input for virtually every part of modern economies, from transporting goods to producing electricity, so when oil jumps, consumer prices for energy and fuel quickly rise. This is evident in numerous countries. Gasoline prices in the U.S. have soared, with national averages reaching levels last seen in 2023. In Europe, where gas prices were already high, the additional oil shock is threatening to raise inflation just as it had started to decline. Indeed, central bankers are openly talking about the second-round effects, where initial energy price spikes lead businesses to raise prices across the board and workers to demand higher wages, thus fueling core inflation. These developments mean that the fight against inflation has become more challenging. Central banks like the ECB and the Bank of England have signaled readiness to tighten policy further if necessary, despite already slowing economies. The persistence of energy-driven inflation has effectively delayed any chance of interest rate cuts in many parts of the world and keeps global monetary policy on a cautious footing. Subtopic: Winners and losers in markets. In the midst of these tensions, energy companies have been clear winners in the market. Shares of major oil and gas producers are up significantly, as high oil prices directly boost their revenues and profits. In the U.S., large integrated oil firms and shale producers are reporting windfalls, while in the Middle East region, stock markets in oil-rich countries have outperformed broader global indices. Conversely, sectors heavily reliant on fuel, like airlines, shipping companies, travel, and even consumer goods retailers, are on the losing end, as investors anticipate narrower profit margins. Transportation costs are rising, which could also dampen some e-commerce and global retail companies that depend on shipping goods worldwide. Additionally, tourism and airlines worry that sustained high jet fuel costs might restrain travel demand or at least profit growth as companies like airlines hesitate to raise ticket prices too much. Investors are actively shifting their portfolios, increasing exposure to energy and commodities while trimming stakes in energy-sensitive sectors, resulting in a notable market rotation aligned with the oil price moves. Subtopic: Government responses to energy shocks. Governments around the world have been responding to cushion the blow of high energy prices. Some countries have released strategic petroleum reserves to add supply to the market, attempting to cap how high oil prices can go. Others have introduced or continued fuel subsidies and tax breaks for consumers, though such measures can strain public budgets. The U.S. government extended a program to provide relief for low-income households' heating costs and has explored diplomatic channels to encourage allies with spare oil capacity, such as certain Gulf nations, to increase production. Meanwhile, in Europe, discussions about accelerating renewable energy adoption have gained urgency as a way to reduce dependence on volatile fossil fuel markets. These actions all aim to mitigate the immediate hardships of pricey energy. However, economic advisors caution that policy tools have limits. If geopolitical conditions remain tense, mitigating measures can only partially offset the global market forces driving prices. Subtopic: Comparisons to past oil shocks. The current situation has drawn comparisons to previous episodes of oil shock and stagflation, such as the 1970s energy crises. Yet experts also point out critical differences in today's context. Modern economies are far less oil-intensive than they were in the 1970s. It takes about half as much oil to produce a unit of GDP now, thanks to efficiency improvements and shifts to services and digital activities. Additionally, central banks have more experience and credibility dealing with inflation today and have so far managed to keep longer-term inflation expectations relatively anchored. However, the risk remains that a prolonged conflict could start unanchoring those expectations, which would require far more forceful economic interventions like much higher interest rates, a scenario policymakers hope to avoid. So, while the oil shock of 2026 is a serious headwind, there's hope that the global economy's improved resilience and a proactive policy response will prevent a repeat of the deep stagflationary recessions of the past. Investors and business leaders continue to monitor the situation, understanding that the trajectory of oil prices and conflict resolution efforts will significantly influence global markets in the weeks and months ahead. Subtopic: Long-term energy market changes. In response to the oil price volatility and supply concerns, long-term shifts in energy strategy are likely to gain momentum. Countries and companies have been starkly reminded of the risks of over-reliance on any one region for critical commodities. This could accelerate global investments in renewable energy sources and alternatives such as battery technology and electric vehicles. Indeed, the market valuations of clean energy companies have been rising as investors bet on a faster green transition spurred by this crisis. Meanwhile, some nations may also double down on energy security measures for example by investing in domestic production of oil and gas, or forging new strategic energy partnerships beyond the Middle East. Over time, these changes can reshape global trade patterns as energy importers in Asia and Europe seek greater self-sufficiency. While these adjustments won't ease today's immediate oil price spike, they are part of the narrative of how the current crisis could leave a lasting impact on energy policy and the financial investments flowing into the energy sector for years to come. 9. India grapples with rising inflation and a slipping rupee. Paragraph 1. India's economy, which has been a powerhouse in recent years, is facing new headwinds as inflationary pressures mount and the rupee approaches record lows against the US dollar. After a period of easing price growth, the latest data show that inflation in India is ticking up again, defying expectations that it would continue cooling through 2026. Soaring global oil prices and persistent supply chain uncertainties, partly due to the Middle East conflict, have contributed to costlier fuel and imports, complicating the central bank's task. The Reserve Bank of India, RBI, finds itself in a bind. Higher inflation would normally call for tighter monetary policy, but raising interest rates could weigh on India's growth, which has been a bright spot globally. As a result, the RBI is adopting a cautious stance, likely to keep interest rates on hold in the near term while closely monitoring inflation trends. The bank aims to balance price stability without choking off the economic momentum that's made India one of the world's fastest-growing large economies. Paragraph 2. A particularly visible sign of India's current challenges is the decline of the Indian rupee, which is nearing the psychologically significant 100 Indian rupees per US dollar threshold. The rupee slide has been driven by factors including the widening trade deficit, expensive oil imports due to global price spikes, and foreign investors pulling capital out of emerging markets amid higher returns in the US and other developed economies. India's currency depreciation carries mixed implications. It provides a boon to exporters like the nation's IT services giants and other industries that earn in dollars, but it raises costs for import-dependent sectors such as energy and electronics. A weaker rupee can also make foreign education and travel more expensive for Indian citizens, and it can feed into domestic inflation by making imported goods pricier. The government and RBI have taken steps to manage volatility, including using foreign exchange reserves to smooth out sharp moves. However, sentiment around the rupee remains cautious, and local businesses are bracing for potential continued weakness in the currency unless global conditions turn more favorable. Paragraph 3. India's financial markets and economic policy are closely intertwined with these macroeconomic trends. The Mumbai stock market has shown resilience so far, with many firms continuing to post strong earnings, but investors are keeping an eye on how higher input costs might affect corporate margins. Rising inflation can hit consumer demand if households start spending more on essentials and less on discretionary goods. Indian policymakers have historically been sensitive to inflation's impact on the population, particularly food and fuel inflation, which directly affects living standards, and thus may consider targeted measures like fuel tax adjustments or subsidies to ease the burden on consumers. Meanwhile, India's growth story remains fundamentally intact for now. Domestic demand and government spending have been robust. Finance analysts stress that the key for India is to navigate this period without allowing short-term price spikes to derail longer-term growth prospects. How successfully India manages inflation and stabilizes its currency in the coming months will not only shape its own economic trajectory, but also serve as a barometer for emerging markets' resilience in the face of global financial turbulence. Asterisk subtopic: RBI's cautious stance on interest rates. The Reserve Bank of India, RBI, is signaling a careful approach amid rising prices. Many economists had hoped that India's inflation would continue to ease in 2026, but global factors, notably elevated oil prices, have changed that narrative. Instead of cutting interest rates to spur growth, the RBI is likely to hold rates steady and carefully watch inflation trends. This cautious stance means India's policy interest rate may remain at its current level for an extended period rather than coming down. The central bank aims to ensure inflation doesn't spiral out of control asterisk, while also being mindful of supporting growth. The RBI's challenge is nuanced. Raising rates might quell inflation, but could also deter borrowing and investment. Lowering rates could boost growth, but risks further weakening the rupee and fueling price pressures. Therefore, the RBI is asterisk balancing a delicate act, ready to adjust policy if needed, but preferring not to overreact unless inflation shows signs of becoming entrenched. Subtopic: Impact of oil prices on India's inflation. India is particularly sensitive to oil price swings because it imports a majority of its crude oil. The war-induced surge in global oil prices has directly fed into headline inflation in India, pushing up costs for fuel and transportation across the country. This not only raises the price at the pump for consumers, but it also increases input costs for businesses, leading to higher prices for goods and services. The government is closely monitoring the situation and has, in the past, cut certain fuel taxes to provide relief when oil prices soared. However, Such measures can only do so much if global oil stays high. Continued high crude prices pose an upside risk to India's inflation forecast, and if the situation persists, it might force the RBI's hand towards policy tightening. On a positive note, if oil prices were to retreat on the back of a peace resolution or increased supply from global producers, that would quickly help alleviate inflationary pressures in India and strengthen the rupee. Subtopic: Foreign capital flows and the rupee's slide. The weakening rupee is not just about oil, it's also about foreign capital flows. Over the past few months, higher interest rates in the US and other advanced economies have lured global investors into shifting funds from emerging markets to safer, higher-yielding assets like US Treasuries. India, with its deep capital markets, has felt this impact. Some foreign institutional investors have pulled capital out, contributing to downward pressure on the rupee. When investors withdraw money, they sell rupees to buy foreign currency, often USD, causing the rupee's value to drop. The government and RBI have been using currency reserves to stabilize the rupee, and they have also continued to encourage foreign direct investment inflows to provide a counterbalance. A weaker rupee, if too rapid, can be harmful by fueling import inflation and increasing the local currency cost of servicing external debt. The authorities' goal is to manage a gradual depreciation without panic and perhaps allow some decline to help exporters while preventing any destabilizing capital flight. Subtopic: Winners and losers from a weak rupee. A depreciating rupee creates mixed outcomes in India's dynamic economy. On the positive side, export-oriented sectors like information technology, IT, services, pharmaceuticals, and textiles can benefit as their products become cheaper and more competitive in global markets when priced in foreign currencies. This often leads to higher rupee earnings for these companies and can boost their stock performance, something reflected in the recent relative outperformance of some IT and export company shares on the Bombay Stock Exchange. Conversely, industries heavily reliant on imports, such as oil refining, electronics manufacturing, and automotive, face rising costs as they pay more for imported crude oil, components, or raw materials. Consumers, too, experience the downside. The cost of imported goods like smartphones or certain food items can rise due to the rupee's weakness. Tourism can see a double-edged effect. Inbound tourism might increase as India becomes a cheaper destination for foreigners, but outbound travel for Indians gets costlier. In net terms, policymakers prefer a stable currency, as rapid moves either way can unsettle the economic planning for both businesses and consumers. Subtopic: India's robust IPO market defies global trends. Amid these challenges, one bright spot in India's financial scene is the continued vibrancy of its stock market and initial public offerings, IPO, climate. Indian startups and companies across sectors, from fintech to manufacturing, have been tapping equity markets, either through IPOs or new share issuances, reflecting a surprising degree of investor confidence. In the past week alone, multiple Indian companies have launched successful IPOs or announced plans for public fundraising, even as global markets fret over war and inflation. This suggests that domestic investor appetite in India remains strong, buoyed by the country's long-term growth story. More retail investors have entered India's equities market in recent years, aiding liquidity and resilience. The relative optimism in the local equity market is a testament to improving financial literacy and rising participation as Indians seek to invest savings in stocks and mutual funds. This strong IPO pipeline in a period of global uncertainty underscores how India's financial ecosystem is maturing, though sustaining it may depend on keeping macroeconomic conditions stable. Subtopic: Interconnection with global finance. India's situation underscores how interconnected global finance has become. The U.S. Federal Reserve's policy decisions don't just move U.S. markets. They also influence capital flows into emerging economies like India. When the Fed raises rates or is expected to stay hawkish, money can flow out of India's bond and stock markets as global funds reallocate to dollar assets. Similarly, a war in one region can drive up oil prices, which then directly affects inflation and currency values on the other side of the world. This interconnectedness means that India's policymakers must keep an eye not just on local data, but also on events in Washington, Riyadh, or Tehran. The RBI's task in maintaining financial stability involves coordinating with global peers and being prepared for external shocks. India's experience is a microcosm of how emerging markets navigate a financial climate dominated by events and decisions in bigger economies. It's a reminder that in 2026, no economy is an island. Global economic ties mean local markets are sensitive to international moves. Asterisk subtopic: long-term confidence versus short-term caution for India. Despite the current challenges, long-term confidence in India's economy remains intact among investors and institutions. Many international funds still see India as a high-growth story, underpinned by its large young population, digitalization wave, and pro-business reforms. Over the longer horizon, the expectation is that India can weather short-term inflation shocks and currency fluctuations, continuing on its path as one of the world's fastest expanding major economies. However, the short term requires careful management. Both government and central bank have to remain vigilant. If inflation rises too much, it could hurt lower-income households and spur public discontent. And if the rupee falters too quickly, it may deter foreign investment or necessitate sharp rate hikes. The coming months will test India's economic resilience and policy agility. Observers are watching whether India can maintain its growth momentum while putting a lid on inflation, a feat that, if achieved, could further solidify its status as a burgeoning economic powerhouse in the global arena. 10. Banks push back against new stablecoin regulations. Paragraph 1. A brewing battle is unfolding in Washington, D.C. over the future of digital currencies and banking, as major U.S. banks push back on proposed legislation for stablecoins. The Digital Asset Market Clarity Act, commonly known as the Clarity Act, is a bill that aims to create a regulatory framework for stablecoins, cryptocurrencies pegged to assets like the U.S. dollar. The act passed the House of Representatives last year with broad bipartisan support, but in recent weeks it has stalled in the Senate due to contentious provisions that would allow stablecoin issuers to pay interest or rewards to users. The American Bankers Association, ABA, and the Bank Policy Institute, powerful industry groups, issued a rare joint statement opposing these provisions. They argue that allowing stablecoin providers to pay interest on digital dollars could undermine traditional bank deposits, as customers might move funds into stablecoins to earn higher yields. This dynamic, the banks warn, might divert money from the traditional banking system, affecting banks' ability to lend and support the economy. Paragraph 2. The conflict is fundamentally about who gets to issue and profit from digital dollars. In the U.S., only government-regulated institutions, like banks, can take deposits and pay interest, a system designed to protect consumers and maintain financial stability. Stablecoins, like Circle's USDC or Tether's USDT, effectively function as digital dollars but are largely issued by non-bank entities under different regulatory regimes. Banks contend that if these crypto companies are allowed to offer interest or rewards on stablecoin holdings without the same level of oversight and capital requirements that banks face, it creates an uneven playing field. In particular, they point to SEC accounting rules, notably SEBI 121, that require banks to hold extra capital for crypto assets they custody, a rule that doesn't apply to non-bank peers, as proof that current regulations put banks at a disadvantage. The proposed Clarity Act tries to balance these differences, but banks fear the bill still doesn't ensure equivalent safeguards, meaning that non-banks could offer services similar to bank accounts without comparable regulation. Paragraph 3. Policymakers and the crypto industry are also weighing in. The stablecoin issue has the attention of top politicians. Even President Trump has publicly supported the Clarity Act, framing clear crypto regulations as important for American financial innovation and national competitiveness. Some senators, too, are keen to see this legislation passed quickly, arguing the U.S. must provide clarity to keep fintech development at home rather than pushing it overseas. However, the stablecoin dispute has exposed a deep rift between the traditional banking sector and the crypto industry. Crypto companies argue that banks are overplaying the risks to protect their turf, and that giving consumers access to interest on digital dollars is a natural evolution of finance. Meanwhile, The banking lobby is pressing for amendments, claiming stablecoin issuers should be held to standards similar to banks if they perform bank-like functions. The legislative process has slowed as lawmakers try to reconcile these views. Prediction markets suggest the bill's fate is uncertain, though odds of eventual passage have been growing. The outcome will shape not only the future of stablecoins in the U.S., but also how banks and fintechs coexist in the rapidly evolving digital asset ecosystem. Subtopic: Yield-bearing stablecoins versus bank deposits. At the heart of the bank's objections is the idea of stablecoins offering yields akin to deposit interest. Traditional bank accounts pay customers interest based on their deposits, funded by the bank's lending activities. But stablecoin issuers have proposed offering rewards or interest to users for holding their digital coins, which are typically backed by assets like U.S. Treasury bills. The banking industry fears that if these stablecoins become popular as a place to park money with returns, people and businesses might shift large sums out of bank deposits and into stablecoins. This could deprive banks of a crucial source of funding, deposits, that they use to make loans in the real economy. Banks argue that if stablecoin providers can do this without the same regulatory burdens, such as maintaining FDIC insurance or strict capital ratios, it's an unfair competitive advantage and potentially destabilizing to the financial system. They want any new law to ensure that stablecoin issuers face comparable oversight if they provide interest-bearing products. Subtopic: Clarity Act progress and sticking points. The Digital Asset Market Clarity Act is a landmark piece of legislation that would finally set clear rules for digital assets, but it has hit a crucial snag in the Senate. The version passed by the House in 2025 drew strong majority support, indicating broad agreement that the U.S. needs to legally recognize and regulate stablecoins and other crypto products. However, during Senate negotiations this spring, the issue of stablecoin interest, or yield-bearing stablecoins, became a flashpoint. Senators Thom Tillis, Republican North Carolina, and Angela Alsobrooks, Democrat Maryland, circulated a compromise draft in April aiming to restrict stablecoin issuers from paying explicit interest while allowing some reward mechanisms. This draft missed a key committee deadline after the banking lobby ramped up its opposition. The process now continues behind closed doors, with banks preparing detailed amendment proposals. The timeline for passage is uncertain. Some proponents hope to revive the bill ahead of the summer, but others suggest it may slip toward year-end given the complexity and lobbying intensity. Subtopic: Banks' competitive concerns and regulation asymmetry. Banks' resistance to the proposed stablecoin framework stems from both competition and regulatory asymmetry concerns. They emphasize that non-bank fintech firms currently issuing stablecoins operate under lighter regulatory regimes, often as state-chartered money transmitters or trust companies, without the same federal oversight or deposit insurance requirements that banks must adhere to. Additionally, banks have to comply with strict capital rules, like the SEC's SAB 121, for any crypto-related custody or activities, effectively making it very costly for them to engage in the stablecoin market. This combination means that without changes, stablecoin startups could offer services similar to banking, digital dollars and payments, more cheaply and flexibly than banks can. The banking sector thus seeks a framework that either levels the playing field by imposing equivalent safeguards on stablecoin issuers, or ensures that stablecoin operations remain closely tied to banks or subject to bank-like regulation. They argue that anything less could shift financial activity outside the regulated banking perimeter, with potentially unpredictable consequences in times of stress. Subtopic: Political dynamics and unlikely alliances. The stablecoin regulation debate has created unusual alliances and tensions in politics. Normally, one might expect pro-business conservative politicians to align with banks, but in this case, the Trump administration and some Republicans are championing the stablecoin legislation as a means to foster innovation and keep the U.S. at the forefront of financial technology. This has put banking lobbyists in a tricky position, opposing a measure that the current government supports and that many see as necessary for clarity in the crypto space. At the same time, some Democrats, typically seen as stronger on bank regulation, are sympathetic to big banks' concerns about deposit safety and systemic risk. The result is a mix of cross-party negotiations where lines are blurred. This has slowed the bill's progress, but insiders report momentum is still present, with a push to possibly get it through by midsummer. The involvement of noted crypto advocates like Senator Cynthia Lummis underscores the high stakes. She warns that delaying regulatory clarity risks pushing fintech innovation out of the U.S., a point that resonates even with some policymakers who have been critical of cryptocurrency in the past. Subtopic: Crypto Industry's Perspective. Cryptocurrency industry leaders see the stablecoin legislation as a pivotal moment for the legitimacy and growth of digital finance. Firms like Coinbase and several major stablecoin issuers have publicly argued that bringing stablecoins into the regulatory fold, even with limitations, is far better than leaving them in a gray area. These companies assert that consumer protection and innovation are not mutually exclusive, and they have largely supported the Clarity Act's goal of creating clear rules. However, they are pushing back on last-minute changes that they say favor banks. Crypto advocates argue that banks' dire warnings of deposit flight are overblown, noting that stablecoins currently function mostly in crypto trading and cross-border transactions rather than as replacements for savings accounts. Moreover, they claim the banking industry's real motivation is to stifle competition and preserve their dominance in the payments and deposit market. The crypto industry is mobilizing its own lobbying efforts and grassroots campaigns to ensure that the final stablecoin framework is one they can live with, emphasizing how stablecoins can improve payment efficiency and financial inclusion if properly regulated. Subtopic: Implications for the future of finance. The outcome of this stablecoin regulatory debate could have long-lasting implications for the financial system. If the Clarity Act passes and allows credible stablecoin issuers to operate under clear rules, perhaps with bank-like regulation for the largest ones, it could integrate the crypto dollar system with traditional banking, spurring innovation in payments and potentially providing competition that leads to better services or rates for consumers. On the other hand, if banks' concerns lead to an overly restrictive law or to further delays, the development of stablecoins might shift to other countries with more accommodating frameworks, potentially causing the U.S. to lose its edge in fintech. Some financial technology experts believe the ideal outcome is a balanced approach where banks and fintech firms collaborate. For example, banks issuing their own stablecoins or partnering with tech firms, ensuring that stablecoins are safe but also widely accessible. One thing is certain: how regulators decide to handle stablecoins in 2026 will shape the intersection of traditional banking and digital assets for years to come, either ushering in a new era of regulated digital money or reinforcing the divide between crypto and banks. Subtopic: Investors and market view of stablecoin debates. While this regulatory tussle might seem arcane, investors and markets are paying attention. The prospect of a clear stablecoin law has been viewed positively by many in the market, as it could remove uncertainty and attract more institutional participation in the crypto space. Some financial analysts note that if stablecoins become officially recognized and regulated, mainstream adoption of these digital dollars could accelerate, making international payments faster and possibly even influencing how central banks think about central bank digital currencies, CBDCs, Bank stocks haven't reacted strongly to the news yet, partly because any impacts will be long-term and contingent on how exactly the law is shaped. However, certain crypto-related stocks, like fintech and blockchain firms, have shown some volatility around regulatory headlines reflecting how significant these policy decisions could be for their business models. In the grand scheme, the stablecoin regulation fight is a prime example of the evolving nature of finance where new digital instruments challenge traditional institutions, and how the rules of the game adapt will help determine the future landscape of banking and financial markets. Video description: YouTube style. In finance and banking news today, Top 10 Market Developments. We dive deep into the latest financial news and market analysis. This comprehensive video covers 10 major topics shaping the global finance and banking world, all from today's perspective. We discuss the Federal Reserve's leadership change and what it means for interest rates, the surge in U.S. inflation to multi-year highs, and the record-breaking rally in stock markets driven by tech and AI enthusiasm. We explore the upcoming SpaceX IPO, set to be the largest in history, and its implications, plus the strong Q1 earnings from big banks, and why their CEOs are cautious about future risks. We also examine banking regulatory reforms that could unlock billions in capital, the challenges in the global economy amid war-driven energy shocks, and the specific pressures on India's economy and currency. Finally, we highlight how geopolitical tensions and volatile oil prices are impacting markets, and cover the ongoing debate between banks and cryptocurrency firms over stablecoin regulation. Tune in for an insightful, research-based breakdown of the financial world's most pressing stories, complete with analytical context and what they mean for investors and the economy. Disclaimer: nothing in this video is financial, legal, or medical advice. The content is for informational purposes only. Tags: SEO keywords, finance news, banking sector, stock market update.